Welcome to CFTC Talks. I'm your host, Andy Bush. Please remember, there's an important disclaimer at the end of the show you should listen to. Hey, January was a busy month with the U.S. tax cuts officially starting and the State of the Union and Janet Yellen leaving the helm of the Federal Reserve. But it didn't take long for volatility to go bananas in February. And this all occurred right after the U.S. released data on the U.S. unemployment situation and inflation. And that data fed a lot of market fears that really were out there that more than expected rate hikes would be coming from the Federal Reserve and other central banks. So, it was a fascinating January, and February is just crazy so far. And here to make sense of it for us is chief economist from French bank Natixis, Joe LaVorgna. Now, Mr. LaVorgna has been an economist for over 20 years with Deutsche Bank and now with Natixis and joins us from New York. Joe, welcome to CFTC Talks.
Thank you very much, Andy. Happy to be here.
Great. Let's get to the meat of this quickly, and let's not mess around. In the latest market moves, what has stood out to you?
Sure. So, Andy, the move last week, which after the fact everybody, of course, saw coming, does seem to be rooted in expectations of the Fed being more aggressive. And investors could see that if they look at the swaps market and what the market had been expecting the Fed terminal rate to be. And we basically, over the past 2 months or so, 3 months, priced in another 50 to 75 basis points in rate hikes. In fact, a few days ago, the market had been discounting a funds rate up near 250, which was the most amount of tightening that the market had priced. You have to go all the way back to 2010. And of course, when you then get any kind of news that might suggest the Fed may follow through on that in the form of either stronger than expected jobs or, more importantly, the wage number that I think you alluded to, surprised a little bit to the upside, everything's set in motion, what turned out to be a sell-off. And then, of course, the way the markets have been with so little volatility, a cascade of selling and positioning and leverage all kind of sped up the process. But to me, this is all about the Fed. I hope they're listening because I don't see much inflation there, and it would be a mistake in my mind if the Fed, they may be going in March, fine, let that be the case, but I hope they don't go much more beyond the March hike, the expected March hike.
Joe, let me ask you about the Fed. What have they been saying, not only about inflation, but also about the markets overall?
The thing, Andy, is that we have a lot of vacancies, as you know, and a new Fed chair. Mm-hmm. And the reality is we're not really sure if this Fed, the composite of the FOMC is going to be more hawkish or dovish. We don't really know. Marvin Goodfriend, I don't know if he's been officially sworn in, but there are some key governor positions that are still open. So we don't know whether this Fed is going to allow the economy the opportunity to run hot, possibly, which I believe I'm the correct view, that these tax cuts are more of a supply-side development than demand-side. But the traditional Fed staff is probably going to view this more as demand-side Keynesian, and they might be chirping in the Powell's ear to maybe move rates more aggressively. And unfortunately, while Powell's a very astute businessman and attorney, I'm not sure, not being a non-economist, he will fully be able to grasp the intricacies and the nuance of some of these models. He may not be able to push back forcefully, which to me means that whoever the vice chair of monetary policy or vice chair of FOMC, to me, Andy, is very important because that's going to determine, in my mind, what the Fed reaction function is to what's happening post the tax reform bill, and of course what happens with financial markets, what the reaction is to them.
Yeah, great point. The lack of personnel really hinders, to some extent, the Federal Reserve from having a fulsome discussion on what rates should be. And you brought up Jay Powell. We're beginning the era of Chairman Powell taking over. And I guess what an introduction it's been with the volatility in the markets. What do you think are going to be his priorities, and how do events like the past week maybe change them, if at all?
His priority, and the reason why I'm guessing, there's two reasons why we think we know why he was appointed. One is that it was relative, we're assuming a relative same monetary policy approach as Janet Yellen, right, with the one caveat being the second reason is that he would work with Randy Quarles, who's vice chair of supervision, to take a more wholesome, selected approach to Dodd-Frank in a way that perhaps Yellen didn't want to pursue. But so I think to me that the mission is going to be trying to figure out ways to improve upon Dodd-Frank, which my guess are many. But we're not really sure what his approach to monetary policy is going to be. I don't know how immersed he is in the economic statistics. I remember listening to Greenspan. He knew all the distribution channels for so many different industries and companies that, Chairman Powell does not have that reservoir of knowledge. His skill set is different. So therefore, Andy, to your point about filling vacancies, those other people are going to be very important because this does need to be a very collaborative team effort. And my fear is that markets, just because they just like to press and push and find the weak points, just may press the Fed until Powell comes out and says something, perhaps that Humphrey Hawkins or what was Humphrey Hawkins later this month. So we don't know yet. We think we know, but we don't know what his approach to policymaking is going to be.
Great point. Well, let's back it up to some of the things I mentioned in the introduction and talk about what's been driving some asset prices higher over the last year. I mean, it's been strong economic growth and increased optimism over U.S. corporate earnings from, pretty straightforward from the tax cuts. And so Joe, break this down for us, starting with economic growth. Where have we come from and what do you expect we're going, in 2018?
So GDP during the full cycle growth was around 2%, 2.1, and then last year we accelerated to 2.5. That data to me is not robust enough because demand was really strong. And when I look at the numbers, my strong sense is GDP will be revised up. That would make much more sense with a lot of other data, such as those from the purchasing managers and various sentiment indices, which suggest GDP should have been up closer to 4. So wow. We were in this world of 2% was trend. Last year we got to 2.5. I wouldn't be surprised when we get the revisions this summer. We find that growth was 3. And then in terms of growth this year, 3 to me seems like it's a good number. Could be a little bit more, but 3% is good relative to the trend we've had. And my guess is, Andy, that if we get that forecast is correct, it's going to be really because of a further step up in business investment.
Yeah, I wanted to ask you about that. So what's your expectation for equipment outlays or CapEx? Because, as we look at the tax cuts, unfortunately, people don't look deep enough beyond just tax cuts to look at a key component of the reform that was put out there, which is full expensing for 5 years. And I think, right. and that to me, just correct me if I'm wrong, but that seems to be the driving component to the positive outlook for CapEx.
It is, but I also think we've got the foreign repatriation. That money's coming back in a relatively tight labor market. It's not all going to be given to workers or given to buyback. Some of it might also go to CapEx. And of course, just the tight labor market itself is going to, in my mind, lead to more capital deepening, try to get that capital to labor ratio higher. Last year, CapEx grew about 9%. I'm rounding up.
Okay.
Coming out of the recession, it was up 20. But we had a number of years back in 11 and 12, to be more precise, where we were growing in the 12 to 14, 15% range. So low teens to me seems very doable this year. And if you're getting more capital spending, you're lifting wages because then wages can rise because it's productivity induced, and that'll help lift consumption. So you get these multipliers, the good sort of, not the Keynesian multipliers, but the good sort of multipliers where someone's spending is someone else's income, and I could see consumption rising as well. In fact, this has been the only business cycle where consumer spending has not hit a 4% rate. So therefore, we look at the economy, it's been soft, we know it's old in terms of years. My guess is there's still a lot of pent-up demand on the consumer side, and I'd argue you could see it perhaps best in just residential housing. The fact that starts at only 1.1 million units are way below where they would ever be in the past, even accounting for demographics. So to me, as long as the Fed doesn't become too aggressive, there's plenty of room to let this economy run, of course, led by the capital spending side.
Well, and you brought up consumer spending, and obviously a big driver of that is whether you have a job. So the unemployment rate at 4.1%, that's pretty good, and we keep creating jobs at a steady pace. And I know in one of your reports you say that the Fed has conditioned investors to believe that low unemployment produces faster wages, which generate higher prices. And so I guess the question to you is this happening?
No, I don't see it happening, but the market is worried about it. I mean, They've heard a lot of speeches. Yellen, interestingly enough, backed away from that last year. And she became a bit more nonplussed about what was driving inflation. But you have people like Bill Dudley, God bless him, who is still very much of the mindset that eventually, just like Godot is coming to dinner, the low unemployment rate will drive wages higher and cause higher inflation. And look, I mean, it could happen, but that's not statistically a very robust relationship. But the market, again, has heard it so many times, and there's no other framework with which the Fed drives the inflation process other than something derived from an output gap, that you have to assume that the market's going to get nervous as that rate goes low. Because Andy, if you have 3% growth this year, you've got to assume the unemployment rate's going to go lower.
Right.
So that's why I'm been writing and trying to push back against this notion that we're going to have this inflation spike, because they get really worried the Fed will see that sub 4% unemployment rate and hike in anticipation of inflation that really never materializes.
Yeah, I think that's fascinating. It's almost like confirmation bias. I mean, it's not really a good example.
Cognitive dissonance might be better, more apropos phrase.
I'm sorry, listeners. I get a lot of this stuff wrong. No, I think it's interesting because if you don't have anything but one framework, well, that's the only framework you're going to use, right? So that's right. That's a fascinating way of looking at it. Well, let's put this all together then, and let's talk about how the Fed is, maybe under Yellen before we get to Jay Powell, because we don't know what he's going to do. But I mean, the people that are there, how are they looking at the economy right now? What do they see that drives them to anticipate 3 rate hikes along with reducing their balance sheet?
So it's the notion of where neutral is, right? Where is the neutral rate? And there's some debate about that. Generally, people believe it's lower than what it was, much lower than what it was prior to the crisis.
Right.
It's somewhere probably, Andy, between 2 and 275, depending on what the inflation rate's doing. So the Fed believes that if it's somewhere in that range, and most of them are more at the high end of that range. I shouldn't say the high end. I mean, that's the median. So there's some that are above. But essentially, where do we need to put policy so that it neither accelerates nor decelerates the economy's rate of growth, which is great in theory, but it's awfully hard in practice to figure out what that rate is. If you ever even know what it is, it's only obvious after the fact. But there's another complication, Andy, and that's the balance sheet. And what troubles me is that you have the balance sheet unwinding. And I'm not sure the Fed had a lot of estimates that said it was worth over 100 basis points in terms of rate reductions. And
right.
You just have to wonder if that's the case. Not that rates are going to spike a whole lot from here, but you just wonder whether the liquidity that the Fed put in the system via quantitative easing is going to hurt as tightening comes out. And maybe we're giving that short shrift. Maybe that's one of the reasons that markets are going to be more volatile and perhaps more prone to the downside. If at any point, Andy, it looks like the Fed's going to be a bit more aggressive than the 3 hikes and then 2, of course, next year that the people are talking about.
Yeah, I think it's interesting. When you go back and take a look at the discussion about the balance sheet from the Federal Reserve and what they were anticipating as sequentially what they would do, the first things that I saw from Bernanke was that they would raise rates and keep the balance sheet unchanged. And maybe down the road, after they were done with raising interest rates, they would let the balance sheet begin to roll up. Now they're doing it simultaneously. And not only are they doing it simultaneously, Joe, but I think perhaps, and I don't want to put words into the market narrative or the market participants, but maybe what they're looking at is as you go out into 2018, when you have these rolling off the Fed's balance sheet, you're increasing the supply of those securities at the same time that, as we just found out recently, that borrowing by the U.S. Treasury is going to go up. So we're talking about a fairly significant increase in the amount of securities back into the system. To me, and correct me if I'm wrong here, but that seems like that's a recipe for rates to go up and create additional supply and maybe some additional volatility.
Yes, but here's the thing, Andy. If you look at the total size of the Fed's balance sheet to GDP, it's still 24%. It's 4 times what it was prior to Lehman.
Right.
And the Fed always told us that it was really more about the stock than the flow. Now, you're right. This year, you're going to have a bunch of securities roll off anywhere from $300 to $400 billion, which is sizable. It's a big amount.
Right.
However, in absolute terms, you still have a tremendous amount of of high quality, long duration assets that have been taken out of the market. And the problem, of course, is going to be that if you have any financial wobble, that's going at the margin to deter the Fed from, well, not that they're going to accelerate the balance sheet, they're not, but raising rates. So what I've argued with the Fed, what the Bernanke-led Fed has done. Poor Janet Yellen, she had a good track record, but she inherited his mess, and of course Powell now is going to take over. But the problem is that you've got the Fed that has been so involved in these markets, they've taken so much risk premia out, especially through forward guidance, that people have reached for yield, they've taken on leverage, and they've been in asset classes that they probably shouldn't be into because volatility was suppressed by all this unique monetary policy.
Right.
And it's just. So I mean, Richard Schiller wrote a book, The History of Interest Rates. They were never negative, even going back to the Roman times. So I mean, not that the Fed didn't take rates negative, but this unconventional policy is truly unconventional, and I don't think we were quick enough in the crisis in trying to remove it. We're stuck with it, and now you're right. You raised a great point, Andy, about the Treasury having to issue more. Let's say the Fed tries to pull back, or is the Fed's pulling back on the autopilot, rates spike. The Fed now has opened itself to tremendous political criticism. And I argued this years ago. I'm not just saying this now. And that's, I think, going to be a very uncomfortable spot for monetary policymakers to be in. But I blame previous leadership for putting us where we are at the moment.
Yeah, it's certainly going to be extraordinarily challenging, and in the sense that they've never done this before. I mean, I just want to make that really clear, that not only have they never created a balance sheet of this size before, but they certainly have never tried to take it back down. So it seems to be intuitive that we would get uncertainty created by that, and adding into.
They want it both ways.
Right?
Because it helped on the way as you're doing it, and they're trying to mitigate trying to make it so it doesn't hurt on the way out.
Right.
But I'm dating myself, Andy. But there was this old, the old days. You had the football game, and you had these little players that were their magnets on a board, and you had a little cotton swab that was the football. You put all your guys on the board, and then you plug it in. It would just like make this horribly loud sound, and all the pieces would move in a random direction. And I kind of feel like those are the Fed's models. That it looks good when you first draw it up, but then actually when you do it, everything falls apart.
I had that growing up. You're not that old. I had that growing up. It was hilarious. It looked great. This big long field, you plug it in, and it's just a sheet of metal that vibrates, and all these things just kind of bounce all over the place, fall over. Yeah. Oh, that was one of my favorite toys. Let me switch gears a little bit and talk about some other markets we haven't got to yet, which are commodities. Prior to the equity market sell-off, oil rallied, industrial metals like copper and platinum rallied. What was driving that move? I mean, is it the expectation of faster growth, or is it CapEx? What do you think was driving that, Joe?
Yes, I mean, to me, the commodity sector is really a play on global growth. Oil, in particular, is the main commodities has recovered a bit. The dollar's been weaker, but here's the thing, Andy. Here's how I think of it. If you look at global growth, last year was the first year where all the major regions and economies of the world were all expanding. That hasn't happened since 2007. But 2007, that was the fourth year in a row in which all economies were growing. So
oh my gosh.
If we're in this period of global expansion for at least another year or two, I've got to think that commodities will do reasonably well, because there's only so many of them that you can pull out of the ground at a given point in time, and that those prices should reflect it. So I'm kind of bullish on commodities.
That is a great point. And this is, ladies and gentlemen, this is why I love having Joe on, because he provides the context that so often is missing when you read articles, wherever you read them, and you hear that, we had synchronized global growth, and this is the first time in a long time, and so on. No, it occurred in 2007, and there had 4 years of it. So that really is helpful, because when you start to look at what can happen in the future, you go, this is not an anomaly. This actually could continue for some time.
Exactly.
You're stunned.
Myself, Andy.
All right. All right, Joe. I stunned Joe LaVorgna there. That's not easy to do. Okay, so one last question before I let you go. I got to ask you, what are the top three things you're going to keep an eye on over the next 3 months?
Number one, the yield curve, twos, tens, that Treasury spread. The good news is it's widened out over the past month while equities have weakened. If that spread, which is around 70 basis points, gets inside at 25, you're supposed to be a little bit more nervous.
Right.
But when it's flat to inverted, you get really nervous, but typically it leads the stock market by several quarters. So if you're getting more worried about the business cycle ending, you still have some time to get out. So I'd watch the yield curve. Secondly, I would watch any type of high-quality credit spreads, double Bs, or single B relative to triple A's, or some credit metric, high yield spreads to treasuries, something that has some type of credit component, because typically credit deteriorates as cash flows and growth are weakening and often not seen elsewhere in the data. I'd watch that. And then thirdly, I would be really interested, Andy, again, in who's running the Fed with Jay Powell, and really listen to the speeches and try to figure out the nuances. As someone told me a long time ago, getting the business cycles right, in large part, are determined by understanding the Fed leadership and how they operate, what their reaction function is. Those are the things I'm watching.
Joe LaVorgna, Chief Economist at Natixis Bank. Thanks for coming on the show today.
My pleasure, Andy. Great to be with you. Thank you.
That's our show for this week. If you want to listen to more podcasts, you can go to our website at cftc.gov and click on the podcast button. Or you can go to the podcast button on your phone and type in CFTC Talks and click subscribe to get them every week. You know, we cover everything we watch at the agency, from interviews with weather experts to the chairs of the powerful House and Senate ag committees to economists like Joe LaVorgna. Check them out. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. This is CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.